Here's a quick list of year-end financial moves that you can do so that you can feel more prepared going into next year and to make sure you're getting the most out of your money before the year closes. So the first thing to consider is a Roth conversion. Lots of people think that they actually have until tax time to do this, but that's really not the case. They think that because the deadline for IRA and Roth IRA contributions is actually tax time. But for Roth conversions, that's not the case. The due date is December 31st of each and every year. So the real benefit with Roth conversions is that you pay the income taxes now and not later. And also, in addition to that, Roth IRAs, unlike traditional IRAs and 401ks and other tax-deferred retirement accounts, are not subject to required minimum distributions. The downside to this, and one question that we get a lot, is are Roth conversions, do they fulfill the RMD requirement? And the answer to that question is no. If you have an IRA and your required minimum distribution is, say, $12,000, you can't do a Roth conversion for $12,000 and then say, hey, IRS, all good, I took the money out. They're going to say, no, that's not the case. That's a conversion. That's a separate item there on your tax return. So the next thing, and I think this is something that a lot of people overlook, is a qualified charitable distribution. This is perfect for you if you have charitable intentions, but you haven't given this year. If you have already given this year, then you may just want to keep this in mind for next year. But how it works is if you're 70 and a half or older, you can contribute directly from an IRA to a charity. And you can even do this from an inherited IRA or a SEP IRA or a simple IRA. With simple IRAs and SEP IRAs, you can't currently be contributing to them. So you basically have to be retired if you have those accounts and want to do a qualified charitable distribution from them. The charity you give to has to be a qualifying 501c3 charity, and it has to go directly to the charity. So you can't give to like a donor advised fund or something like that. It has to go directly to an organization. So the real benefit to doing this is that qualified charitable distributions are not included in taxable income. And in addition to that, they can also satisfy your RMDs either partially or in full, depending on how much you decide to give. So the catch with these is the money has to go directly from the custodian, as in that's the financial organization that physically holds your money. It has to go directly from them to the charity. So it can't be in your hands at any point. Another thing too is the catch with qualified charitable distributions covering your RMDs is you can't have already taken the RMDs. So for example, if you took your RMD back in June and now you're deciding, okay, my RMD, let's say for example, it was $12,000. And you decide that you want to give $12,000 to charity, and you think, well, okay, that should wipe out my RMD. It covers that, and now I don't have to pay taxes on it. That's not the case because the RMD has actually already touched your hands. So if you're taking your RMD on a monthly basis or quarterly basis, or if you've just already taken it this year, then this is something you might just want to file away for future tax planning purposes. Do the qualified charitable distribution first, and then that should satisfy your RMD. You can't do them in reverse order and have that work. That's just not how that works. So one thing to note here is, unlike a regular distribution from your retirement account, like if you take money out of an IRA, you'll get a 1099-R, and usually there's a little code, and if you don't do your own taxes, this is something you might not really even pay attention to. With qualified charitable distributions, there is no code on the form that says QCD or something like that. So if you work with an accountant or if you file your taxes yourself, write QCD in the memo line next to that distribution, and that's what accountants usually do. So if you work with a financial advisor, ask your advisor to send a summary to your accountant to make sure it doesn't get missed. This is a very important step unless you want a surprise income tax bill. So another thing you can do before the end of the year is to harvest capital losses. The way this works, if you haven't done it before, is you sell off positions that have had a loss throughout the year. So if you bought a couple stocks in a non-retirement account, and this is very important because this only applies to non-retirement accounts, taxable accounts, individual, joint tenants with rights of survivorship, but not IRA, not Roth IRA, not 401k, just individual accounts that you hold positions in with losses. They can be stocks or mutual funds. You can sell those before the end of the year, and then you can write off up to $3,000 of losses against your ordinary income. So if you unexpectedly had more income this year than you were expecting, and you feel like you're going to have a larger tax bill than you were originally hoping for, and you're trying to get that down a little bit, selling off those positions with losses can be a great way to do that. And key thing here, make sure you don't buy back that investment within 30 days because that triggers the wash sale rule, which makes the loss disallowed. So don't think like, oh, hey, it's December 15th. I'm going to go sell that off, get the write-off, and then go buy that back on January 1st. You're just going to cause yourself tax problems for next year. So don't do that. Another thing you can do along the lines with harvesting losses is rebalancing your portfolio. So if this year you've had stocks that have done very well and bonds that have not done very well, and your original portfolio allocation was something like 60-40 and now it's 70-30, now's a good time to sell off some stock gains and rebuy some of those positions with losses. So by doing this, you're keeping your portfolio in balance, and you're also selling high and buying low. So RMDs are the next thing. Don't forget that these have to be done by December 31st of each year, unless you're turning RMD age in the current year. In that case, you can defer your first RMD until April 1st of the following year. Just note that the next year, you're actually gonna have to take 2 RMDs in a single year. So if you do this, you're kind of just delaying the inevitable. And if you miss an RMD, you get an IRS penalty, and nobody wants that. So make sure you do it. So for gifting, you can gift up to the annual maximum per person each year without filing a gift tax return. A lot of people ask me if they receive a gift, do they have to file a tax return? And the answer to that is no. It's really the giver that has to worry about that. But just because you file a tax return doesn't mean you actually have to end up paying taxes. So in 2025, the annual gift allowance is $19,000 per person. So that means if you are married and you have 2 kids, for example, you can give each kid $19,000 per spouse. So that means that you could give a grand total of $76,000 if you're a husband and wife with 2 kids and you want to maximize the amount of gifts that you can give away. You can go up to that amount. And again, this is for $2025. It's going to adjust each year. So always double check that gift amount, but you don't have to file any additional forms with your taxes. It's only if you go beyond that it starts to count towards your lifetime maximum. And even then you don't necessarily pay taxes. It's only once you get up into the tens of millions of dollars that you really have to start thinking about it. So a couple bonuses here, year-end things to consider if you're not retired and maybe you're a business owner. FSAs, I've never been a huge fan of these because traditionally the way they've always been is use it or lose it. And by the way, FSA stands for Flex Spending Account or Flexible Spending Account. But now the way it works is your employer might allow an extension into the following year of 2.5 months, or what they might allow you to do is roll over a certain dollar amount, which changes every year. For 2025, it's $660. For 2026, it's $680. And so what that means is you can roll up to that amount forward into the same exact account next year and not lose it. If you have like $1,000 in your account, for example, and your employer allows you to roll that forward, just keep in mind that potentially up to $340 in that case is at risk. So that is the use it or lose it case with FSAs that you don't have with something like HSAs, but it's not helpful to you if you already have an FSA and you can't switch over to an HSA. So what you want to do is just use that money before the end of the year. And so then the question becomes, okay, well, what types of things can I use that on? A common thing is prescription glasses. But FSAs actually have a gigantic list of things you can use them for. There's even certain over-the-counter medications, first aid supplies, there's dental care, there's hearing. So the list is actually very long. So if you're worried you might lose some money, think about what you don't currently have in stock. Band-Aids, it could be thermometer, it could be certain vitamins, and maybe what you want to do is just go ahead and stock up. Assuming you don't have $2,500 in your FSA and you don't want to spend $2,000 on random supplies. But each FSA has an eligible expense list. So you can check with your employer for that list. And I'm not affiliated with them, but there's actually a website called fsastore.com where you can go in and just search for products that are typically FSA eligible, and you can buy directly from them. Or if you're just looking for some ideas on what can I actually use my FSA on, then that's one of them. SEP contributions are due by December 31st if you are a business owner with a SEP. 401ks, 403bs, and thrift savings plan contributions are also due by December 31st, but those contributions are typically payroll deductible and just happen automatically. So it's really the SEPs, if you're trying to make a last minute one-time year-end contribution, that you have to be cautious of if you do own a small business and have a SEP established or want to establish one. And along with that, if you're a business owner, if there's any last minute thing that you want to spend money on, like say software or equipment for your business or any type of marketing expense, you can knock that out before December 31st and have that still be a tax deduction deduction for the end of the year. Some additional bonus things you can do, which aren't necessarily as financial dollar sign related. Double check beneficiaries on IRAs, 401ks, life insurance policies, annuities, because life changes quickly and before you know it, it went by and you forgot to update that beneficiary. So double check those and make sure it's not like an ex-spouse or someone who's deceased. These are things I commonly see. Really, you just need to reach out to the company and let them know you want to make a beneficiary change. Sometimes you can do it on the website. Sometimes you have to fill out a form, which can be a pain in the butt, but there's never going to be a fun time to do it. So add it to your list, knock it out, and you'll feel a lot better. If you have some extra time over the coming few weeks before the end of the year, assuming you're watching this at the end of the year, but at any case, whenever you're watching this and you've just been putting it off, think about your will, your power of attorney, your medical directives. If you don't have those in place, or if they just need to be updated, now's a great time to start thinking about it. If you can happen to grab time with an estate planning attorney, they probably really aren't super busy this time of year. They might be, but I feel like most of them wouldn't be. Or now might just be a good time to start researching an attorney who can help you out with this and get them on the calendar for next year. And think about when next year would be a good time to go sit down and meet with them. That one is one I'd say the sooner you can get it done, the better. If you've already met your insurance deductible, my question to you is, do you have any additional procedures or tests or checkups that you need to have done that you haven't? If so, then get those done before the end of the year and take advantage of having met your deductible already, and let that health insurance company just pay that bill for you because they make enough money as it is. And that's it. So those are some year-end things that you could consider. These are common things that we talk over with our clients. Hope you found this video helpful. Feel free to go back and rewatch chapter by chapter if you feel like that's necessary. And if you have any year-end things that I missed, then feel free to leave them down in the comments to share with others and help them out. So that's it. Hope you enjoyed the video. Please like and subscribe for more clear retirement planning content, and I will hope to see you in the next video.